Good morning. This is Business Morning. Thank you for joining us. I'm Chimeze Obi Iwagu. We'll begin on the global oil market space as prices continued to plummet as concerns over demand and limited remaining storage capacity lingered. In the afternoon of Asian trading hours, international benchmark Brent crude futures dropped 13% to $16.82 per barrel. Meanwhile, the June contract for West Texas Intermediate shed all of its earlier gains as it fell 3% to $11.20 per barrel. The July contract for WTI was near flat and last traded below $19 per barrel. Global demand for oil has fallen dramatically, with major economies worldwide effectively frozen as a result of coronavirus-induced lockdowns imposed by authorities scrambling to contain the spread of the disease. Wednesday's move in oil followed recent sharp declines in the sector. The May contract for WTI, which expired on Tuesday, plunged below zero for the first time in history before clawing its way back into positive territory. The June WTI contract plunged more than 40% on Tuesday, while international benchmark Brent dropped from levels above $24 per barrel. And here is what the United Nations World Food Programme has to say on global food crisis. The world is at risk of widespread famines of biblical proportions caused by the coronavirus pandemic. David Beasley, head of the World Food Programme, says urgent action is needed to avoid a catastrophe. Its latest report estimates that the number suffering from hunger could go from 135 million to more than 250 million. And those most at risk are in 10 countries affected by conflict, economic crisis and climate change. The fourth annual global report on food crisis highlights Yemen, the Democratic Republic of the Congo, Afghanistan, Venezuela, Ethiopia, South Sudan, Syria, Nigeria and Haiti. In South Sudan, 61% of the population was affected by food crisis last year. Now, even before the pandemic hit, parts of East Africa and South Asia were already facing severe food shortages caused by drought and the worst low-cost infestations for decades. In a call to action, the WEF chief says, and I quote, "I do believe that with our expertise and our partnerships, we can bring together the teams and the programs necessary to make certain the COVID-19 pandemic does not become a human and food crisis catastrophe." End of quote. And Nigeria, just like the global economy, is expected to slump into recession due to the impacts of COVID-19 pandemic. And one of the main pointers to the looming recession for Nigeria is the currency pressure that Africa's largest economy has been grappling with. Examining some of the critical areas to be affected, a research firm, CFG Advisory, takes a look at the historical trends of currency devaluation spanning a period of 10 years. The Chief Executive Officer of CFG Advisory, Mr. Tilewa Debajo, joins us now for some analysis of the report. Good morning. Thank you for joining us, Mr. Debajo.
Good morning.
So what is the significance of this report at this time that Nigeria and, of course, the rest of the world is grappling with the COVID-19 pandemic, coupled with the drop in oil prices?
Well, first of all, I think it's important to realize that we have two major crises on our hand. First of all, we have a health crisis. And that health crisis has also resulted in an economic crisis. And I think globally, all the economies around the world are shut down. I think China is the only country that has been through that cycle. The problem haven't started from China. And right now, we're having to deal with not only a health crisis, but also an economic crisis. So it's a double jeopardy, and it's important that all hands are on deck to make this happen. So there's no isolation for Nigeria in the sense that this is something that is global. And one of the major problems is the fact that oil prices have gone to historically low levels. And you know how important oil prices are for us. We've adjusted our budget from $57 a barrel to $30 a barrel. That resulted in a 90% loss for us in oil revenues.
And even at that, we're still not there yet.
So we need $15 billion to plug the budget deficit this year.
Okay, now your report looks at the devaluation trend between 2010 and 2020, from 151 naira to the dollar in 2010 to between 380, and of course, as at today, in the parallel market, should have 450 in 2020. Now, what does this tell us?
Well, what we've tried to do, first of all, is to understand how the currency devaluation has impacted on the Nigerian economy. Taking a look at it back from about the year 2000, over a 20-year period, what we saw was about a 400% devaluation over that period. What I think is more significant for us is the fact that over the last 4 years, from 2016 till today, we've seen a 100% devaluation in the Naira. And we've tried to understand the reason for that. One of the reasons is the fact that we have a static exchange rate mechanism, which does not revalue the Naira. For instance, when oil was trading over $100 a barrel, the Naira should have been devalued. And what we tried to do was to compare that with the dollar and the pound and the euro to see their devaluation trends also over a period of 10 years. And what you see with those currencies, because they have a market-driven exchange rate mechanism, is that you see prices going up and down, appreciation, depreciation, depending on the economic situation. And what is important is that while we have gotten from just under 100 naira to about 450 naira today, their own band of devaluation is going from maybe 0.6 to 0.9. So you can see there are very thin margins in there while we are going through exponential devaluations and really no revaluations. So really, that's really where the challenge has been, and that has impacted our economy significantly, and we're facing another pressure right now. And I think without a doubt, when the foreign exchange markets open, there's so much pressure that I think maybe about $2 to $3 billion is already waiting to leave Nigeria, and that will put more pressure on the Naira. As you've said, on the parallel market, the Naira is already trading at 450 Naira to 1. And if you take a look at the international markets, the non-deliverable forwards are trading at about 515. So that shows you in terms of where the future rate of the Naira would be. So we're looking that the Naira will be probably somewhere around 515 in another 6 months.
Now, the central bank governor earlier this year had explained that the last supposed devaluation is actually not a devaluation, but an adjustment to the Naira. But I kind of wonder, devaluation, adjustment, does that really make a difference?
Well, the challenge they've had is that they've been operating a static exchange rate mechanism with multiple windows. You had a rate at 305 for government. You have another rate for pilgrims. You have an exchange window for the export proceeds. So when you have too many multiple windows, then you cause a distortion in your exchange rate markets, especially when that mechanism is also static. So I think because of the pressure that you can see, because the reserves at about 34 billion right now are also under a lot of pressure. So with that pressure, what they had just done was to consolidate all those windows into one and basically have one single window. So that's one step, but the next step now is to make sure that exchange rate mechanism begins to be more market-driven as opposed to be static.
Now, from where we are, do you see us having further devaluation really on the Naira?
Yes, I think from the signals you can see that, first of all, we have a 90% reduction in our budget from oil revenues. So oil revenues were budgeted before at about 2.5 trillion. Right now, we're expecting 244 billion. So that's a 90% decrease in oil revenues. And oil is not even trading at $30. So that money is going to be significantly reduced. We've gone to the IMF, the World Bank, and the African Development Bank to raise about $7 billion. We still have another $7 billion that we need to raise to plug this budget deficit. As I said earlier, there's pressure on the reserves. We also have this pandemic shock that is leading to GDP contraction. As you know, that the economy itself was already fragile before we got this pandemic shock, in the sense that the economy was only growing at about 2.5%, and our population was growing at about 3.5%. So that's why we have over 100 million people in poverty. And more to add that, we have unemployment at about 30%. So if you take a look at all these pressures and the fact that the foreign exchange market has been closed for a while, when the markets resume trading, a lot of pressure would have built up. And these foreign portfolio investors have about $27 billion in our short-term securities. But luckily for us, most of that have been hedged with some swaps. So there might not be too much pressure. But what we see is that within the next month or so, with all the economic headwinds and the pressure on the system, it's likely that, you know, the parallel market, as you've said, is already at 450. So within a month or two, it's not very difficult for us to see the Naira hitting 500.
Now, for you, in carrying on your research, what are the sources, what are the major sources of uncertainty for you in the FX market?
Well, the major sources of uncertainty is the fact that, as we've said, the oil revenues have dropped by 90%. So basically, we are not going to be able to maintain our level of reserves. So that is initially the big pressure because of the oil price. That's a direct correlation in terms of that. And we've only been able to source $7 billion. And we have to try and raise money to be able to plug the other $8 billion we need for the budget deficit. So that's really where the pressure is. That's where the direct pressure is. So hopefully, if the oil prices improve and the palliatives that have been announced, we can try to see how they can stabilize it, and hopefully that will help us out. But basically, it's the drop in oil price that is really causing the pressure right now.
And why is exchange rate volatility an issue for an investor?
Well, let's put it this way. In 2016, if I had $1 million, I would have gotten 200 million Naira for that $1 million. Now, there are two choices I have. Do I take that $200 million, change it to dollars, and invest abroad? But if I decided to take the $1 million at 200 million and Nigeria and invest it in Nigeria 4 years ago, I would have to be battling 100% devaluation and 12% inflation. So I have to have at least an asset over the last 4 years that would have returned 150% for that investment to be worth my while. However, if I'd left $1 million in a domiciliary account and was getting interest in a bank, today, as you've said, I can change that 100 million and I'll get 450 million Naira. So if there is no investment, you take a look at the stock market here today is down about 14%. And if you take a look at the cumulative effects and try to pick the best stocks even in the Nigerian markets, if you didn't have the swaps and the hedging instruments to protect you, there's no way you could have made those returns. So that's why it's important that the exchange rate is good for the investor. But apart from the investor, the local industry is also under pressure. The manufacturers, you know, will be sourcing foreign exchange at a higher rate, and then it's going to have an inflationary impact because they're going to have to pass on those higher costs to consumers, and things become more expensive.
Now, how can the CBN improve in stabilizing the market?
Well, what the central bank, the situation where the central bank is now is that central bank is responsible solely for monetary policy. That is really where they make an impact. And right now, they've gone beyond monetary policy, and you can see they've done a lot of intervention. They've announced a ₦1 trillion intervention for the manufacturing. They've announced some intervention for pharmaceutical and the health sector to address directly head-on this issue of the health crisis we're facing. And they also put out 50 billion Naira for SMEs and households to be able to access that, to be able to see them through this crisis. So the central bank has already put out some palliatives, both immediate on the short term and on the medium term. And on the medium term, they're looking to set up a 15 trillion Naira infrastructure company to be able to address the infrastructure deficit. So they've responded by looking at several interventions. And of course, we know that they have intervention funds in the market, which they've cut those rates. But if we take a look at the primary function of the Central Bank of Nigeria, which is to look at monetary policy, it seems to me that monetary policy has reached its limits, because over the last 2 years, the central bank has not changed its rates, and it's maintained the same rates and the same ranking. So therefore, what it's trying to do now is looking at the loan-to-deposit ratios of banks and trying to get banks to lend more. But if your economy is growing at 2.5%, you have to be very careful so that these banks don't go and loan out and begin to have more bad loans, because right now we have about 12% NPLs within the banking system, and that is something we need to manage. So it's now time for us to look at more of a coordinated effort. Not only monetary policy, but we have a fiscal deficit that we need to address. And there needs to be more coordination, not only with the central bank. So with what central bank is doing, we also have to take a look at the fiscal side with the Ministry of Finance. We also have to take a look at the trade and investment policy with the Minister of Trade and Investment. So those three agencies have to work in synchronization, and somebody in the presidency has to be able to coordinate all these three activities and make it work. Because apart from that, you know, we're also adding the Ministry of Health into this, because we also have a health crisis. So you have the Ministry of Health, you have the central bank, you have the Ministry of Finance, and you have the Ministry of Trade and Investments that all have to work together in synchronization to get us out of this health crisis and also resolve the economic crisis.
So what mitigants are you suggesting to, you know, to the impending devaluation and economic downturn?
Well, I think that is nearly inevitable. There needs to be more of structural adjustments within the economy itself on the long term. Because as we've said, monetary policy has become ineffective. Rates have become static over the last 2 years. So we have to now look at some sort of structural reforms within the system. Clearly, the government cannot sustain the level of its recurrent expenditure. And something needs to be done about that. There's an Oronsoye report that talks about how you want to be able to consolidate government and make it more effective. I think we need to dust up this report and take a look at its relevance today, because we need to start taking steps, bold steps, to get this done. But I think what is, for me, is even more important is that we need to have this presidential task force on the health. The health crisis, I think, is on the foreburner. And I think it's important that we resolve this issue, because health is wealth. Without resolving the health problem, the economic issues would pale in comparison.
So what's your recommendation on how investors can possibly proactively hedge against a possible devaluation and all this economic downturn?
Luckily for us now, we have FMDQ has an OTC futures market. So in order to reduce the speculation, I think it's important that the central bank promotes FMDQ's OTC market. And part of our reserves anyway, what is happening is that the central bank already has part of the reserves for the portfolio investors in terms of their swaps. So what we need to do is that we need to be able to activate this market and make it more proactive so that we can reduce the speculation with the futures market and people can begin to buy their forward contracts so that there's no speculation that will just make the price of foreign exchange shoot up unreasonably.
All right. Thank you very much for your time, Tilewa Adebajo. I'll be speaking to Tilewa Adebajo, the CEO, CFG Advisory. And after the break, airline losses continue to rise as a result of the COVID-19 lockdown. Details in a moment.